What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. This week, Don Schneider, Deputy Head of U.S. Policy at Piper Sandler and former Chief Economist for the House Ways and Means Committee, joins Stephen and I to break down Treasury's surprise buyback announcement, the worsening fiscal picture, what comes next for tariffs, and why AI and data center policy may become the next major political risk for markets.
Don, thanks for coming back. There's been some big news this week on Treasury's buyback program that really moved markets. We're really interested to hear your thoughts on the announcement this week.
Thanks for having me back on. Besson there was, of course, that announcement, and then he did a follow-up interview on CNBC for about 20 minutes to explain it. The comments he had made said the 30-year is very thinly traded, and they were going to take action to buy back. And the goal is you buy back those thinly traded tenors, and then you reissue at something else at some other tenor that's more desired, whether that's bills or the belly of the curve. And that came as a surprise. Is the Treasury Department panicked? Are they concerned? Have we met some threshold at rates? And so when he elaborated in the interview, he basically said, he alluded to a couple things, Iran and related issuance that's competing. So if that AI debt is very long-term and is competing with the 30-year and pushing up rates, he also mentioned Iran and just being August and it being a thinly traded period. So all of those factors were kind of why Treasury decided to intervene. I think a lot of clients have been confused. Why are they doing this? And it's not going to change the fundamentals in the market. So there were a lot of questions about that. How long are they going to do this? How committed are they to doing it? Treasury Secretary Besson had said, we have a lot of tools at our disposal. The number we announced is a minimum. So I think it raises questions. Is this just for the 30-year? Is it more? And how does this affect their overall issuance strategy as we get the quarterly refunding announcement where Treasury decides how much they're going to issue it? And Cantor, you and I were on a panel with Steve Myron, and we were talking about his paper on activist Treasury issuance. Where they were making the case that the Yellen Treasury was being political by issuing too many bills and kind of stimulating the economy, keeping long rates down. So there's been this question, when is the Treasury going to move to raise coupons? And now that the kind of talk in markets is, are they going to be cutting coupons, or what do they do? So I'd say that's the kind of broad overview of what's been talked about. And then the other thing is, Besson alluded to some fiscal consolidation that would, of course, help to address the more fundamental issue at the long end.
So you just mentioned, and this has come up, or it's returned to the news a little bit in the conversation, in 2023, we did have that big announcement from Treasury Secretary Yellen that had a pretty big and sustained impact on the market, at least for several months, both equity markets, which were suffering at the time from higher yields. And I believe thus far that was roughly the peak in the 10-year yield at around 5%. What's different about what Treasury Secretary Besson has announced or implied compared to what we had heard from Yellen in terms of the potential outcome or potential impact?
I think that the size is a lot different. And when Yellen had talked about raising coupons, meaning we have to raise the gross auction size at the long end of the curve, the market's going to have to digest more of that long-term issuance and it caused term premium to rise. It's a larger mechanism than just buying back, say, 30 years or 20 years and trading issuance. But I'd say the effect of them is pretty similar. You're changing the overall composition of treasuries and the kind of weighted average maturity of the portfolio. So I think the main difference is size. I know Besson had talked about this in his interview. It wasn't just like the size of the announcement. I don't think it's $4 billion or something like that. It's pretty small per $4 billion per issue, but he said it's the signal is part of it. In effect, we're choosing to intervene. I think that's what remains to be seen is what is the scale of commitment and what is their goal? It's not really clear what the goal is and how far they're going to take this. Maybe the other thing I could say, as he noted, or at least implied, this is not addressing the fundamentals in the market. And when it really comes to those fundamentals, it's the deficit. And so that's what I've been taking the most incoming on. He said we're going to announce as soon as next week a new kind of fiscal consolidation approach with Russ Vought, who's at OMB. He's the director of the Office of Management and Budget. And I think there's a lot of skepticism about this, and perhaps rightfully, DOGE was not a big success. You could, of course, go about this more effectively, but really the administration doesn't have a lot of unilateral authority to affect spending. But what he had teased, and that was saying we're going to look at both the revenue side of the ledger and spending. He specifically referenced grants that they make to states that are being frittered away, implying they're going to withhold funds, look much more aggressively at fraud and other things. There are plenty of thoughts on that, but that's the other part of this, which it's not just buying back. And then who knows what happens with coupons? Will they cut them? Will they just change the composition of issuance? And then something to address the true fundamentals, which is lowering the deficit.
So Bessent has recently said that there's nothing magic about a $40 trillion deficit number, crossing that now, and that we can grow our way out. So I'm curious, Don, as a former Ways and Means economist, what kind of growth rate does it actually require to get out underneath this?
Yes, you can think of changes in the debt to GDP ratio. Basically, it will grow by the size of the primary deficit every year. Right now, primary deficit is around 3.5%. And then the other portion, the interest cost that basically doesn't mathematically get added to debt to GDP every year. So yeah, if you juice nominal growth, I think we're at like 6.5.
Yes.
Right now, yeah, that helps to inflate away debt. But I think that primary debt burden, our true deficit every year, is you will be in the kind of 3.5 range, and longer run, get into the 4. Yeah, it's not really, you need a fiscal consolidation strategy to grow our way out of this. We can't just rely on growth.
Speaking of the deficit, which has been a topic building up over the last couple months, where are we now on the tariff conversation, which was a huge topic? Roll back the clock 1 year ago today.
Yeah, there's a few components of this, and actually Secretary Bessent alluded to this in his comments, where he said there's been misinformation on the deficit, and he said we had 5%, 5.7% of GDP deficit last year, and the deficit is basically, he said, artificially inflated by tariff refunds, which are a one-time thing. And so the deficit this year will be 2.1 trillion, and tariff refunds are about 100 billion of that. So yeah, you shouldn't bake that 100 billion in every year going forward. But yeah, there are a few kind of disagreements I have with what he said. So last year, yes, as officially reported, I think the budget deficit was like 1.75 trillion, something like that. And so that translates to 5.7% of GDP. And this year, it will be 2.1 trillion. That's a really large expansion year over year. So, first, where I disagree, and this is just a technical comment, when the Department of Education, the cost of our student loan portfolio is recorded on a present value basis, not a cash basis. And so there was a one-time $130 billion reduction in September 2025. So it counts towards that fiscal year, from changes in Big Beautiful Bill, basically made our student loan portfolio, or the offerings we have, less generous. So it was recorded as a big spending cut. So in Bessent's framework, he's saying that lowered the deficit. And then this year, it's a one-time thing. So it's like, I think it's wrong to say, yeah, we had a 5.7% of GDP deficit this year. It was artificially low because of that. And consider it from his perspective then. It's not like the deficit genuinely grew this year because we lost that one-time cut. So I think there hasn't been, he's trying to bank that fiscal consolidation last year. That didn't really happen. And then this year, okay, we're going to have a 2.1 trillion deficit. Remove those 100 billion in tariff refunds as something that's not going to repeat themselves going forward. It's still 2 trillion. That's a big number. That's 6.25% of GDP. And next year, I think it'll be 2.1 or so as well. So no, we're not getting the fiscal consolidation. And as you noted, he said in his interview, yeah, tariffs are low now, but we're going to be right back to where we were before. And completely agree. That's in my deficit forecast as well. So on that front, there are a few ways to think about it. But basically, right before the Supreme Court invalidated IEEPA, his authority he used for broad tariffs, the effective tariff rate was about 10%. So that means we import about 3 trillion in goods. We collect about 300 billion in revenue. Prior to Trump taking office, there were 80 billion. So it's like a 220-ish billion increase in tariff revenues. So it was a 10% rate. We're now at 7. So that 3 percentage point delta translates to about 30 basis points on GDP. That's the kind of deficit expansion from this temporary reduction in tariff revenues. So they've been able to keep us at 7% using what's called Section 301 tariffs in response to other countries not in the US's estimation, not sufficiently blocking imports composed of forced labor. And the second component of this, which will bring that tariff rate back up to 10%, which is delayed, is what's for excess manufacturing capacity. So we're waiting on that investigation. I'm surprised it's taken this long based on where we are now. I guess it won't come until after the midterms, but what that will effectively be is a restoration of the tariff rates that prevailed back in January, right before the Supreme Court struck everything down. So it's just a lot of legal machinations just to get back to the exact same place that we were. So yeah, in my deficit forecast, I assume that will be the case. And even with that increase in tariffs and that restoration, the deficit is still going to be about 2.1 trillion.
Do you think any of that delay is due to the midterm timing? We've started to hear, whether it's Treasury Bessent's announcement or even a few weeks ago, there was a couple headlines about President Trump looking to cut the capital gains rate. We're probably going to get a lot more potentially market moving headlines between now and the midterm elections. So do you think they're waiting until after that to deliver this quote unquote bad news for those consumers, which are obviously continue to have affordability as the top issue probably of the midterms? And what other announcements do you think are possible from the administration or other politicians running for office along these lines that could be market moving between now and those midterm elections?
On the tariff piece of it, he hasn't really taken the off ramp on tariffs a lot or done a lot of things that would say improve his outlook in the midterm. So I don't think there's a lot of concern about imposing tariffs right before the midterms. I think some of this just has to do with manpower. The USTR has to conduct a more complicated investigation to show country by country and establish the fact that there has been excessive manufacturing capacity in each of these countries that they're targeting. And I think there's some of that. There's some election nervousness, maybe some concern about or growth or other things. So I think it's a combination of factors that's leading to the delay. And it's now that we're so close, you may as well wait another couple months. I think every month that we delay, we lose about $7 billion in revenue. It's not a huge number. And I also think some of it gets wrapped up in here's the meeting with Xi later in September. And that I think he has room to dial tariffs. They have a 12.5 rate now. They were at 20 before. If he leaves this action until later, there's some time to use that as leverage, or at least not act yet and make that contingent on some of whatever they are negotiating in September. So there's that, which is obviously a headline that it could come before midterms. It's unclear when it will. There's a few other investigations. We've seen the administration press ahead with, we had tariffs on polysilicon. Those are pretty large tariffs on that, which is mainly about solar. There are a few they announced tariffs on drones, steep tariffs on drones. There's pending investigations on wind turbines, a few other things that could come soon. Potentially tariffs on refined copper is a debate. There's a critical minerals one. It's like a PPE and healthcare supplies. So there are a few more kind of investigations that could manifest in tariffs. And almost in all of these cases, maybe with the exception of commercial aircraft, they've chosen not to impose tariffs. So there are a few more of those announcements coming. Maybe the biggest question I get, is there going to be a bad headline, is really when it comes to data center policy and AI. So maybe there's two things in there. One that maybe would fly under the radar that could be more serious which isn't the kind of what hasn't trickled into our politics about data centers, is back when Moonshot released at Kimi K3, the administration accused them of distilling or basically IP theft. And Treasury Secretary Bessent said sanctions will be on the table. So I think that would be a potentially market moving event if the administration decided to put these companies on the entity list or sanction them or somehow block or restrict access to Chinese open weight models. So there's been a big debate that's been going on in the administration about what to do about that. That would be market moving for sure. The other is just on data centers, which has much more quickly in months. You now see there's a moratorium on construction in Texas, same thing in Pennsylvania. So it's an issue in those races. Trump already has a policy there, the ratepayer protection pledge. He's unique among presidents in working mostly through the private sector and establishing these voluntary agreements using his own personal leverage. So I don't expect Republicans. It is a surprise, right? That in Texas, Governor Abbott saying we're going to have a moratorium in place. That came as a surprise to me. As of yet, I don't think there's going to be, you could see more Republicans walking away from it, because if Democrats are now using it as leverage to say, basically our politicians are selling us out to these companies, giving them tax breaks, building in our communities, damaging the environment. And if that, now that races are super close, I think I saw a poll, the Ohio senator is down, the Republican is losing by 8 points to Sherrod Brown. If you're losing in all those races and the main attack against you is because it's data centers, and that's a red state, I think Trump won it by 8 points, then that kind of forces Republicans to back off. So I don't think they would ever support anything like a national moratorium, but it just means at the state level, you slow things down, and at the margin, you're going to make Republicans more willing to engage in some kind of trade-off where you're going to force these hyperscalers to shoulder more of the burden of the infrastructure build out. So yeah, it doesn't increase their profits. Let's say it that way. They're going to be forced to shoulder more costs, and they'll face a slower build out because of the politics surrounding this. So those are some of the headlines I think that could come up between now and the election on kind of the trade and AI front.
Yeah, that's certainly, as we know, AI drives the markets. And I've been meeting with clients all week in New York and Connecticut, and around AI, the conversation has quickly shifted from CapEx concerns and headlines during earnings season to political concerns, particularly between now and heading into the fall, about these data centers, like we had heard recently in Pennsylvania. All right, Don, this has been great, and it's certainly a lot to chew on. And you've had a busy summer, and you're going to have a busy fall, I imagine. So just to wrap it up, and to where we started off on the Treasury buyback announcements, there was definitely a surprise to many clients. That's what they told me this week. And so the next QRA, I believe, announcement is November 4th, which is a couple of days right after the midterm elections. What are you expecting between now and then, if anything? And what do you expect to hear? Or do you think Bessent is signaling for that announcement in November?
Yeah, so I don't think I think the consensus had been that in markets that it would be next year, or I should say, the Treasury maintains language that effectively you could almost like forward guidance that we're not going to change on issuance. We're going to keep gross auction sizes constant for the next few quarters. And so that had led people to conclude maybe the first half of 2027, they would finally raise the size of auctions. Now people are speculating maybe in November, would they go the opposite way and cut them? Or you could just remove that language, the kind of forward guidance, make it ambiguous, and maybe it could be sooner when they would act. Or you could change composition of the issuance. So rather than say, you could keep the gross auction size. I think it's something like maybe 4.4 trillion for a year in gross coupon issuance. And you could keep that amount the same, but instead of doing as much at the 10-year and the 30-year, you could issue a mix of more in bills in 2 years, 3 year, 5 years, et cetera. So I think that's what's more likely. So I'm not expecting a big change in November. I would think it'd be more like next year, where you kind of toy around with the composition of it. I would be surprised if they started cutting coupons. I think that would signal the Treasury was nervous about the market. And I think it would cut completely against what Bessent had said, that the Yellen Treasury was being irresponsible. So yeah, that would surprise me a lot if they cut.
Certainly for investors that are missing forward guidance from the Fed, we've gotten some from the Treasury Department. So love to be a fly on the wall in the conversation between Bessent and Warsh, and to see how that's shaping things up for how we hear the Fed. I'm sure someone's going to ask Warsh at the next Fed presser what he thinks about what Bessent said. And I'm sure he'll say the Fed has a policy of not commenting on fiscal.
Yes.
We'll see if we hear anything from Jackson Hole. I know Kurt Lewis, our Fed watcher, does not expect fireworks or anything massively new coming out of Jackson Hole, but that's the next big event up for the interest rate market. Thanks, Don. Always great to have you join Stephen and I on the podcast, and we look forward to talking again soon.
All right. Thanks so much. Appreciate it.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.